Good afternoon and welcome to the Hamilton Wealth Partners July Thought Leaders Series webinar with today's guest speaker, Tony Burgess, the Chairman of Independent Advisors, Flagstaff Partners. Look, we're very fortunate to have Tony join us today, given his level of experience and business contacts, as per his bio that we've pre-circulated to you all. I do need to start with just a general advice warning. The information contained in this webinar has been provided as general advice only. The contents have been prepared without taking into account your objectives, financial situation or needs. You should, before you make any decision regarding any information, strategies or products mentioned in this webinar, consult your advisor, consider whether that is appropriate having regards to your objectives, financial situations and needs. A little bit of housekeeping as per normal. There is the Q&A down the bottom, slightly to the left-hand side. If you've got any questions, which we're going to open up for at the end, if you could please put them on the Q&A button. Look, Tony and I talked the other day about what he's seeing at the corporate level and in Australia. There is a disparity, as we've discussed, between Main Street and Wall Street. And this is creating a disconnect as some businesses are really hurt, whilst Wall Street has had NASDAQ's up 24% last year. Look, welcome. Thank you. I know our audience is looking forward to hearing your insights and we'll find them very useful. So I'm going to hand it over to you.
Thanks very much, Will, and good afternoon to everyone. Look, I'm a corporate financier, and so and really the comments, I've got some observations relating to the current COVID-19 crisis and also how we what the future might look like, and they're really from a corporate finance practitioner's point of view rather than strictly a market strategist or an economist's point of view. But it does draw on the various sort of discussions we've been having with clients over the past 3 or 4 months while we've been in this crisis. So just running through. I mean, I've got about let's see. I think about 6 main areas I want to cover, and the first is the economic impact of COVID-19 in Australia, and it's sort of interesting to observe. I mean, it has been a real shock. There's no doubt about it, and we. Despite what markets are doing at the moment, it's been a real shock, and it's brought to the end what has been 28 years of unbroken economic growth here. And it is clear we are in a deep recession, along with the rest of the world. Now, the reality is, that record, I think it's now a record, certainly in relatively modern times, to have had 28 years without a recession. I think the reality is that period of nirvana, if you like, for Australia was drawing to a close in any event, COVID-19 or not, because when you think about it, for the past 3 decades, we've had 4 really strong tailwinds that have driven our economy forward, and the 4 are the China resources boom. Secondly, the growing world trade liberalisation, where we've had up until recently trade probably growing double nominal GDP, and we've benefited from that as an open economy, both importing and exporting. We have had, and this is a very conspicuous feature of our economic growth, we have had very high population growth, one of the highest in the OECD, and that's really been based on immigration. I think we've been running 1.5% per annum. 0.9 of that has been immigration, 0.6 natural. When you look around the world, a lot of the OECD countries, not the countries that have done best economically over the past few decades, have been those who've got population growth, and you put US in that category as well as the UK. Those that haven't, like Japan and most of Europe, have not had great growth. And the final factor, which has been a worldwide phenomenon, has been, of course, progressively declining interest rates, which have certainly supported much higher household debt levels and really have underpinned high asset prices around the world, particularly for hard assets, including property. We'll come on to what's going to happen in those 4 tailwinds going forward. Maybe some of them are reversing, perhaps. So but anyway, they've driven the growth over the past 3 decades, and they've been petering out. And consistent with that, when you look at our economic performance over the past 6 or 7 years, it hasn't been great. We've had growth in absolute terms, but per capita in real income has been flat for the last 6 or 7 years. And that really reflects what's been happening in the broader world economy. I mean, the reality is that pre-COVID-19, the world economy was not in great shape. We've had a slow recovery from the GFC. Productivity growth around the world, certainly the Western world, has been poor. The growth in China has been slowing, and it's, again, for the future, but the pump priming, the effectiveness of the pump priming after the GFC might not be so effective this time round, post-COVID-19. We've had, of course, the growing trade tensions between China and the US, and that may well turn into a headwind. Around the world, the government debt levels have been increasing, and if you excluding World War I, post-World War I and post-World War II, they're a record high as a percentage of global GDP. And reflecting all of these factors and reacting to all of these factors, we've had central banks taking sort of extraordinary actions around the world, including, I think for the first time in recorded history, negative interest rates. In the Euro area, Switzerland, Sweden and Japan. So the backdrop to COVID-19 has been a pretty slowing performance here in the context of a pretty weak global economy. So, that's why this thing is hit so hard. Now, second point to think about as well, how long will it take for us to recover from this shock that we've had, to what we might call it the new normal, but no one knows the answer. I mean, we were fortunate enough on Monday to have a lunch for our clients with the Doherty Institute, including Professor Sharon Lewin, who's the head of the Doherty, and Professor Kshitij Kapoor, who's the Dean of Medicine at Melbourne, and there might have been some of you on this, one of you at least on this webinar was also present at that. And these people know what they're talking about. There's so many different, there's so much noise around all of this, but these people do know what they're talking about. And I think there were 2 key takeaways from that lunch. The first is, which is a good news, they have a very high level, surprisingly high level of confidence that there will be a vaccine. They are supremely confident, in fact. And it might be the one they're working on with, I think there's a University of Queensland initiative that they're working on, and also with CSL. We're very advantaged here in Australia and in Melbourne in particular that we have CSL. We have one of the largest vaccine manufacturers in the world right here. It's got a plant up in Parkville. So there's a high degree of confidence there will be a vaccine. The problem is that it won't be until sometime in 2021. And until then, we're going to be living with this virus. And there will be a continued need for social restrictions to contain the transmission, and probably with some inevitable stop-start like we're experiencing at the moment. We've got these hotspots in Melbourne. And probably with borders, I mean, I think where we will get to, I suspect, is that we will have it under control in Australia and New Zealand. I think essentially it is under control in Australia and New Zealand. We'll have a trans-Tasman travel bubble, but our borders will remain closed to international travel because that's where it's coming from. And that really, and hence, why Qantas is not planning for international travel to resume until mid-2021. And the reality that means is that the economic damage we're experiencing is going to continue. It'll continue. We might get back to, 90% perhaps run rate based on domestic activity, but we're not going to be at full run rate until we get a vaccine. So now it is very interesting when you look at the markets at the moment, both equity and debt, they're pricing the recovery from COVID-19 as if we were in a state of suspended animation, which is hibernation for animals, and we'll suddenly snap out of it come spring, our spring. And I think someone I was chatting to the other day said, the only V around at the moment is for vaccine, V for vaccine, not V for economic recovery. So, so we're still so we're not out of it yet, and it'll take probably the rest of this year and into next year. And clearly, there's a lot of focus on how difficult the final quarter of this year will be, given that we've got, it's not only us who we've got the JobKeeper scheme runs out on a lot of things run out on the 30th of September. JobKeeper, sort of the rent deals that landlords have done, and the forbearance that banks are showing. I think the reality is they will have to be extended. Perhaps JobKeeper selectively, doesn't have to be as broad based as it is, but and it's the same around the rest of the world in terms of the extraordinary sort of emergency economic support measures have been put in place. I suspect that governments are going to have to continue them for maybe a few more quarters before we're on confident footing. So I guess the third area then is, well, once we get beyond, clearly we're going to have these restrictions. Once we get to beyond this sort of shorter term issues with COVID-19, what might the new normal look like? Well, I think there's two key things I would say in that regard, and the first thing is that, look, notwithstanding the massive support packages we've got from government and reserve, and what our Reserve Bank, along with central banks all around the world, is doing in terms of extraordinary. We thought post GFC was extraordinary. They've gone another step in terms of the level of broad-based quantitative easing they're undertaking, including buying corporate bonds and small, central banks giving effectively underwriting small business loans elsewhere. But as I said, that will probably need to continue for some time. But the reality is there's going to be a very slow economic recovery, and unemployment will always remain stubbornly high. We don't know exactly what it is because the numbers are all a bit of a mess at the moment here and elsewhere around the world because of government support. With people furloughed, are they unemployed, or are they just sort of or not? And will they get a job back? Will they be brought back when the government support measures are withdrawn? That's the big unknown. But unemployment's going to remain high for some time, period of years. But why do we think, even if we got a vaccine tomorrow, we're still going to have a slow economic recovery? And I think there are two key reasons for that. One is that households and business are going to be very cautious and will be reluctant to spend and invest. I mean, it's well reported elsewhere, and I think there were some numbers out from ANZ Bank during the week, but the average level of debt for Australian households is 195% of disposable income. That is very high by historical and international standards. And when you have a crisis like this, people are running, those who are stood down are using up whatever savings they've got, and those who aren't stood down are looking at what's happening around them and saying, "Wow, this could get worse. I need to make sure I've actually got I've either got to rebuild my reserves or build my reserves and savings higher." So I think that mentality will continue for as long as we've got high unemployment. And then you've got the other the macro factors that we talked about before, those big four tailwinds that sort of drove our economy along for the last 3 decades. As I said, they've either stopped blowing or they're about to become headwinds. And clearly growth in China has slowed. And importantly, a lot of noise around China at the moment, understandably, but if you look through that and look at what they are doing, I mean, they are, like the Japanese did in the 60s and 70s, they are deliberately diversifying supply sources. I mean, at the moment, I don't think they enjoy paying over $100 per tonne of iron ore because there are some supply issues in Brazil. So didn't get a lot of press, but they have they're proceeding. A couple of Chinese entities are preparing to develop the Simandou iron ore deposit in Guinea, the one Rio. They've got some blocks away from Rio, and because and therefore you would have that is a it's not going to drop iron ore prices tomorrow, but in a couple of years when markets start factoring that extra supply coming in, I don't think you'll see iron ore at $100 a tonne, and that's a big factor in our TWI. As second point, I mean, we are sadly getting, the whole world has benefited from, well, since I guess GATT was formed in the whenever it was in the mid 1940s, we have had progressive international trade liberalisation, and certainly over the past number of years we've signed free trade agreements left, right, and centre, including one with China about 5 years ago. Well, that liberalisation has stalled, and the pendulum is now swinging the other way, sadly, towards nationalism, and it's clearly led by the US, but it's not helpful for them. I think from memory, trade might be 10% of their GDP. Well, ours is at least double that. We are a very open economy, and it does not suit us that trade barriers go up around the world. Immigration, well, we'll come back to that, but in the short term, it has stopped. In fact, gone backwards. I'll come on to that as a big issue for our government looking forward, a big strategic issue. And as we know, immigration, look, I think the important thing is that it brings skills. I mean, immigrants on the whole tend to be younger, and we've got a very good system here, the point system, so we bring in skills that we need. They also have to live somewhere, so you've got the whole economic multiplier effect that they bring. And that's certainly going to be a negative for the housing market and the construction market in the shorter term. And interest rates, well, the reality is, in practical terms, I don't think they can go any. Hopefully, we're not going to get negative rates in Australia, but the reality is they're not going to go lower in practical terms. So that big tailwind is sort of going to be stopped blowing. I don't think it'll be a headwind. So that's why we're going to have a slow recovery. Now, this other element, I think, of the recovery post-COVID, and this is sort of, again, observable all around us, is that there are going to be major structural changes and disruption in the economy. And a lot of that's due to behavioural changes and business reaction to consumer behavioural changes. But I mean, and there's this, for those who did study economics, you'd be aware of Joseph Schumpeter. He had this great economic thesis about creative destruction, and it's the way I guess free enterprise economies grow. I mean, you get innovation, and the new destroys the old, and that's the way you get productivity growth as well. Well, we've had, we have had creative destruction on steroids, I think, in the last 3 months. And there was a quote I saw the other day from the CEO of Microsoft saying that we have seen 2 years worth of digital transformation in 2 months. So we're going to have a lot of structural change in the economy. And this is why I think, straying into your area, Will, this becomes a stock pickers market, because there will be some businesses who will do incredibly well, have done well, and they're structurally advantaged and will continue to do well, even though the general economic environment is weak. And there are other businesses traditional businesses who are probably weak structurally in any event, but they're not going to survive. They're not going to survive this crisis. And when we whether it's, as we know, these changes in behaviour, I mean, people are changing the way they shop. There's the working from home element. There's business travel has stopped. Will come back. Will it come back to the same extent? Question mark. Education is now being delivered digitally. It'll come back, physical presence, but to the full extent. You've got all these question marks, and you've got businesses who are responding to these changes in behaviour, and which will be anticipated to a certain extent to be permanent. Not fully, and hence you've got a lot of challenge businesses. Retailers, and we've only seen the beginning of the various defaults and bankruptcies there. Community newspapers we've heard about, hotels, hospitality, travel, shopping centres. I mean, question about future demand for office space. It goes on and on. So we're going to have a lot of disruption going forward with winners and losers. The other thing that clearly is going to occur is that businesses are looking carefully at, they've discovered that the supply chains, I mean, the whole just-in-time methodology, and it's using the cheapest componentry, even for single, small elements of components in any in product. They've actually discovered maybe that doesn't work so well. Certainly there'll be some diversification of supply sources and some simplification of supply chains, having more of it done in one place, and that will play out ultimately into increased costs when you think about it. Perhaps some onshoring. I don't think it'll come into inflation, because I think we're going to be at so far off capacity for some years, I think. But certainly it'll result in changes. So that's what, so the new normal is going to be, it's going to be a grind out in terms of getting back to sort of real strong economic growth. It'll be a sort of a grind out of this COVID-19, and there will be very radical differences between businesses that are succeeding and those that are not. I think it's, unfortunately, the rising tide lifting all boats. Unfortunately, there'll be a few boats stranded, we think, as this tide has rapidly gone out during COVID-19. Fourth topic I thought would be worthwhile making a few comments on is, what does it mean for government policy, in this sort of environment? Now, clearly, we've got to, as we said, we've got to get past the September cliff, and I think, we will, I'm sure, but fortunately, they overestimated how many businesses needed, or employees needed, JobKeeper, so they've got some money there to keep it going, perhaps selectively, and perhaps beyond September quarter. But clearly, all the money, it's not only here in Australia but elsewhere around the world. I mean, we have much bigger deficits at the moment. They're emergency levels of expenditure. That means government debt goes up. Ultimately, we will have, that has to be repaid someday. I don't think it's an immediate burning issue, but I suspect that probably means higher taxes in the future rather than lower. And clearly more government in our lives. We've got a lot of government in our lives at the moment. But that's all understandable. I think the real challenge and no one's resisting it, I think the real challenge for the government here is what do our medium and long-term policy settings need to be to create the real reform we need, and that we really haven't. Politicians of both sides have really avoided in the past 10 or 12 years. I mean, it's sort of, going back to another famous economist, Paul Krugman. This is a very famous quote: "Productivity isn't everything, but in the long run, it is almost everything." And it's pretty clear in Australia, we've had hardly any productivity growth for 6 or 7 years. And despite the nominal economic growth we've had, so we just, our growth has about been equal to the population growth. So it's very clear we need a far more productive, more diversified economy. And the harsh reality, when you look at where we've ended up after this 28 years of unbroken growth, is that we are very reliant on a handful of commodity exports, particularly iron ore and coal and some agriculture, and on one market, China, with whom we're having some difficulties at the moment. So now, earlier in the year, and it was very criticised here, but probably unfairly and defensively criticised. I mean, Harvard University do an atlas of economic complexity, and they published the last one actually late last year. And it showed that Australia's ranking dropped from, out of 133 countries they surveyed, we were 62 in year 2000, sort of midway, if you like, and we were number 87 in 2018. So ranking dropped, and that's because our economy has narrowed over that 20-year period. And this measure, and we can debate methodology and so on, but essentially what it's trying to do is measure the diversity and complexity of a country's exports. And the thesis is that the greater complexity of exports means that you use more know-how. And know-how, and sort of level of education is another measure of that, is a good measure of the ability of an economy to grow income over the longer term. It's a very good correlation, certainly, and probably causation. So that study, you might recall, got heavily criticised by the Treasurer at the time, but but I think it might be right. And really, what it points to is the fact that we really need some serious reform in skills training, industrial relations, energy policy, which links to climate change, which we have definitely ducked for the last, ever since, go back to 2007, I think, when Howard was proposing an ETS, and taxation, because we've got to, again, we've got to, it's 20th anniversary of the GST, but we've got to, let's face it, a half-baked GST. The rates, the base is too small and the rates a bit too low, and we've got all these other inefficient taxes. So there's actually some really hard work to be done there. Let's see whether in this new consensus environment with the National Cabinet, where hopefully some of these longer-term issues can be addressed. The other thing that I flagged before, we've also got a very big decision to make about immigration and foreign capital. I mean, both, we have always been as a nation an importer of capital because we've got growth beyond our own means, and it's been a great positive for the country. As has immigration, let's face it, apart from the first peoples, we're a nation of immigrants, and a nation of economic immigrants. And that's why generally we've, and immigrants, as I said, they're highly skilled and they're entrepreneurial, and they're a big driver of economic growth. So, there's no doubt we will remain an attractive destination relative to the rest of the world for human capital and also industrial capital and financial capital. There's no doubt about that, because it's a relative game in that sense. And, we should be strategic in that respect, and we should remain open to capital, again, with that sensible limits around security issues, and we should remain open, to immigration, and it really goes to, it's going to be a much more sort of fractious, dangerous world, and perhaps dangerous region, and it's a simple point, I guess. We'd rather, the bigger the population we have within our physical limits, of course, but the more able we are able to, the better able we are to afford, the necessary high-tech military gear and cyber protection that we need to actually protect our own interests. So one would think that would be the strategic way of thinking about it. But let's see what how Canberra is going to think about that. So that's on the government side of things. When it comes to business and how business is adapting to what we might call, what they're seeing as a new normal, well, we're seeing it. It would be interesting if you saw that, that the announcement made by Suncor, I think yesterday, about what their restructure is, and it's pretty typical of what's happening for most corporates, probably big and small. There are four things they're doing. One is they are aggressively right-sizing the cost structure for an environment where there is going to be lower demand and slower growth. And, it's pretty clear that businesses have moved very quickly during the COVID-19 crisis to take costs out, and a lot of costs out. And I think the reality is those costs are not going to come back, because businesses realise that they can probably do more with less, and they're going to have to do more with less. So, hence Suncor talking about, quite significantly reducing its office footprint, for example. They also, the second thing that businesses are doing is back to the consumer behavioural changes. They've shifting. They're realising that online or digital will be a much bigger part of their business going forward. And certainly insurance has been a bit of a laggard in terms of online. And so I think Semcor is now preparing for, so I think they said 20% of their business to be online. Well, that just means lower costs elsewhere. It means less people they need. Businesses also, as I said before, looking at diversifying markets, and the universities in particular have working, to be fair to them, this started before COVID-19. They realised they're a bit too dependent upon one market, being China, and they've been working hard about opening up others, including India, and also supply chain diversification. So business, costs out, adaptation of the business model to sort of what the consumer behaviour is going forward. Simplifying portfolios. A lot of businesses now, I mean, one way of getting costs out is to, the simpler your business, the lower cost you can run it. And so a lot of bigger companies who have got multiple businesses in their portfolio are, looking again at, well, what really is core? And anything that's, I think the definition of core is going to be a lot narrower than it has been in the past, and therefore you'll find that there's the non-core assets are going to get sold. And then finally, and this is very apparent to all of us, the better businesses have been ensuring that they have got adequate capital and adequate liquidity and capital to survive and invest in the new business model. And as we know, fortunately, apart from maybe a week or two in March, markets for debt and equity are open, and they're not, it's not being offered at distressed pricing. I mean, hence we've seen, a lot of we've seen major companies availing themselves of that, both on debt and equity, which is understandable. I might then just finish with some comments on what this means for the M&A environment, given that I guess our main advisory business is around M&A. And look, as a general comment, I'd say that, look, M&A transactions and volumes are very pro-cyclical with the stock market. You would think it should be the other way around. People should be buying counter-cyclically, that's as Warren Buffett would have it. But, it doesn't happen that way. It happens pro-cyclically. And I think that's to do with confidence and the ability to fund. When stock markets are high, people are confident, equity is available. As a currency, debt tends to be readily available. So that's the way it goes. Now, post this COVID, clearly M&A volumes have during the crisis period, they've sort of fallen off a cliff. I suspect, though, that we suspect that there's going to be quite a pickup once we start seeing a bit more clarity about the way forward. And I think there'll be four big drivers of activity. I mean, one is the restructure of failed businesses. So we've seen Virgin fits into that category, but I think there's going to be a lot more of it, particularly retailers in particular, I suspect. But they will end up getting that. That will be sort of deal at corporate finance activity around that. Second one is that there's still a bit of, even though we've got pretty highly concentrated industries in Australia on the whole, there's still some unfinished business on industry consolidation, and there's nothing like an imperative to get costs out in a serious way to actually put those potential transactions back on the table. So subject to the ACCC, I suspect we're going to see some another round of industry consolidation where it's going to be possible, and again driven by the imperative of cost out. Thirdly, and as I mentioned a minute or so ago, that look, large corporates are going to slim down their portfolios. There's no doubt about it, because they are now redefining what's core, and the banks continue to do that. I mean, a couple of them, I think, still NAB is a good example of where they're not yet out of their wealth management business, for example. But examples abound about larger, particularly the large listed corporates who over years have sort of accumulated businesses. I think they're going to, in this environment, they are going to slim them down. Will there be buyers? Well, I think that's the fourth point. I mean, I think there are, fortunately, I mean, there is motivated and well-financed sets of buyers out there. I mean, some corporates, Wesfarmers would fit into that category. They're a corporate, they're well capitalised, they they want to continue their conglomerate model. So they'll buy, they're clearly looking, and they'll buy something large, we suspect. And then you've got private equity who, who pre-COVID-19 had an enormous amount of unused firepower. And, the COVID-19 is sort of nirvana for them, because it means they can start putting some of that money to work. And you've seen a bit of that with, Blackstone buying its 10% interest in Crown, and there'll be, something that follows from there inevitably. They haven't bought that just to sit there. We've got, KKR bought the stake in Colonial First State from CBA, and Bain Capital, of course, they're putting $1.5 billion into Virgin, and the list that list will grow and grow over the next 12 months. So I think actually it's going to be a pretty active time, despite what we're going to say is a fairly subdued economic environment, post this crisis. I think there's actually going to be a lot of activity on the corporate finance front. And I thought I would stop there in terms of my comments.
Thank you, Tony. Look, I'm going to open up for questions, but I'm going to just start. I've been attending a conference in the UK, so I've been attending it virtually over the last few nights. And one of the speakers was a gentleman by the name of Michael O'Sullivan. He's just completed a book, which I'm sure there's a lot of books been written during these COVID times, called The Levelling. He was the former global CIO of Credit Suisse Wealth Management, or private bank. And he talked about one of his themes is what he calls the multipolar world that's commenced. Now, you've touched upon this in point 4, and as he said, there's sort of a European bloc, a Chinese bloc, and a US bloc. And he highlighted one of the two countries which he felt was in a dilemma. So first of all, one of the countries he thought was in a dilemma was the UK. But the second country he thought was in a dilemma was Australia. Mm. He said, you're strategic. And by the way, when he talks about multipolar, he's not just talking about this being economic. It's strategic, as he said, it's down to the internet even, the way that these 3 different blocks approach the internet. And he said Australia is economically dependent on China, but strategically dependent on the United States. So I'm just wondering if you could touch on what your view on, is this a dilemma or not, confronting our country?
Mm. Well, yeah, I think I think given our, as I said, we are a very open economy, very open economy. We need trade, we need foreign capital, and we need people. So it makes sense for us to really be, I think to be on good terms with everyone. And I don't think we've actually been executing too well on that of late, because, it never makes, despite what we might think of China, and clearly Xi Jinping at the moment is testing the limits of what he can do. Why else would he be sort of having a dust up with the Indian soldiers way up in the Himalayas? You think, what is he on about? He's testing the, there's a good Nixonian or Kissinger quote, it might be, which is that nations inevitably want to push their political and military power to the extent of their economic power. And that's what China is doing at the moment. So that's clear. I don't think we need to be gratuitously insulting them. I mean, I don't know, everyone's in business on this call. I don't think that's a good way of dealing with your customers, generally speaking. But anyway, so look, it's pretty clear we've got a strategic alliance with the US. And I don't think that will change. I think we just need to become a little bit more subtle, a little bit more Singapore-like, if I could use that expression, about sort of making sure that we are seen to be a good and effective trading and capital partner with everyone else, while clearly having a strategic alliance with the US. I mean, there was a very good, hard as that is at the moment, there was a very good article written by Peter Varghese, it might have been the Weekend Australian, but talking about actually, the idea that really what you can't, contain China, but we probably need to, and clearly they need to understand there are limits, but we probably need to be a little bit more adept at building coalitions. And he was talking about a coalition of India, Japan, US, and ourselves. And I think there's a lot of merit in that. So I don't think we've got a dilemma. So I don't know that we've got a dilemma. I think it's pretty clear we are so aligned in a military and in a security sense to the US, and that's probably the right. That's history. We're not going to change that. And there are, by and large, they're a bit more similar societies to us than China, perhaps. Yeah. But we then need to be very clear-headed about where our economic interests lie, and that's something that I think there's been insufficient discipline on out of Canberra, not only out of Canberra but generally. So that'd be my response to that.
John's asked if you've got any thoughts on the Australian property market.
Well, look, I think not my area of expertise, but I think that look, you've got a number of different factors going on in that regard. I think shorter term, a lot will depend. I don't think we're going to have a 91 situation because the banks, where we did, I think, what did property prices fall in 91? 20%, 25%. It was pretty savage. And that was largely driven by, the behaviour of the banks in foreclosing and forcing sales. I think you'll actually have, so even though unemployment may get to where it got to in 91, I think in 91 it was, 11%. It may be 11% now. What's different? I think probably the bigger difference, apart from government support, okay, but the bigger difference I suspect is that the banks are going to be more intelligent about it, and I think there's going to be a little bit more forbearance. And I think one of the bigger things that we will, it's not only about extending JobKeeper for selected areas post September 30, but I think it's also making sure the banks have got the ability to continue to forbear where people defer principal mortgage repayments for those who are in clear need. The good thing about this crisis is that the banks, unlike 91, the banks have entered this crisis because of this, what was seen to be a relatively conservative approach by APRA in terms of making sure our banks were unquestionably strong in terms of their capital adequacy. Well, that's actually serving us well at the moment because they are unquestionably strong. So they've actually got the wherewithal to actually, do another 6 months of forbearance. The government will have to lean on them to do it. But I think that's going to provide a bit of a cushion. So I don't think you're going to get a lot of distressed sales. Look, rates where they are, has to help. But the problem will be, what's happening on the income side with the lack of growth and no immigrant. I mean, we're going to have 2 years probably with zero immigration, something like that. All of that mean, I don't know, I'm guessing 10%, something like that. I would have thought it's certainly going to be a softening. It'll be slow to increase, but I would have thought it's within that that sort of area. It's not going to be a 91 to start with.
Andrew's just asked equity valuations in the medium term. What are your thoughts on this and the impact on M&A?
Pardon me. In the medium term, well, I think that one thing, and I know my former colleague Hamish Douglas is very big on this, that you've actually we are going to have low interest rates for a long time, a long time. And COVID-19, I think that was the case anyway before COVID-19. And COVID-19 makes sure of it, and candidly, until we actually start getting some inflation, and I don't think there's any signs of that for a long time. So that really means that we need to, for those of us who have been around for a long time and, think in terms of what PEs used to be. I mean, we just need to, PEs, it's if required, if long-term interest rates are really more like, I think the 70-year average for the 10-year bond rate in the US, I think, was 5% from end of World War II to 5 years ago. What's it going to be for the next 10 years? I don't know, say maybe 2%. So you run that through a model, a capital asset pricing model, and you end up getting even for a business that doesn't have much growth, you're going to have at least a 20 PE on it. That's for a decent business. So you would actually have to say that, and look, I'm not sure about some of the, and clearly market is sort of this bifurcation we've talked about, where those with strong business models, particularly those who are sort of digital, linked to the digital wave they're the ones who have recovered. They're the ones who have driven the US stock market recovery. Some of those might look pricey, but generally valuations are going to be a lot higher than we're in a decade. The next decade, we're going to be, I think valuation is going to be a lot higher for equivalent quality companies than in the last 2 decades. And it's because interest rates are going to be lower, a lot lower, sustainably lower. And I think we're therefore, you might say, I think there are going to be some bumps in because I think, as I said, I think markets probably, they always look forward. We know that. They might be looking a bit far forward. I think we're going to have volatility, clearly, in the next few months, because I think, for the understandable reasons, until we get a vaccine, I think we're going to have volatility. But I don't think equity markets are necessarily overpriced, I would have to say, because I think you have got this situation that, money, where, you're in, where do you, with rates at, let's call it, close to zero and long-term rates under 1%, where do you go to get a decent return? You're going to go to equities, and I think that means valuations are going to be a lot higher than previously was the case. So yeah, I think that's my long-winded way of saying I don't think, apart from the volatility bumps, I don't think we can sit here and say, equity markets are terribly overvalued. I don't think they are. In taking a medium-term view.
Yep. One thing you just, in the question beforehand, before this, from John, when we talk about property market, on this, the virtual conference I've been attending, another guy that was talking was Peter Flavell, who's the CEO of Coutts, which is owned by RBS, now known as NatWest again. He said in the UK, one of the things they're really worried about is they've given mortgage repayment relief, but the banks are really worried that the consumer or the lender is not the borrower, sorry, is not seeing the borrower is not seeing it as relief. They're seeing this as a holiday, total holiday, as in a write-off, and that's what's really concerning them, because guess what? The mortgage does need to be repaid. It's just been extended, and so apparently the banks in the UK are very worried about that.
Yeah, I don't think the banks here are so worried. I heard some stats the other day. I think from Shane Elliott. I think their book, maybe it's consistent with the others. Maybe 10% went on some form of deferral. A lot of those now are saying, actually, on seconds, I don't need it. I'm starting to pay back. And others are, their incomes haven't declined. So I think that's another reason why I think we're going to have, we won't have a property. Well, I'm pretty confident we're not going to have a property wipeout.
Okay, good. Look, I'm going to leave it there with no more questions. But Tony, thank you very, very much. That was a sterling effort. You talking for nearly 40 minutes was unbelievable. So thank you. We appreciate it very much. And I'm sure all the participants appreciate very much your effort. And we look forward to our next webinar. But Tony, thank you.
My pleasure. Okay.
Right. Thank you, everybody.
Bye-bye.
Take care. Bye-bye.